In lecture number 2 of our business strategy series, we discussed a number of measurements of how we can evaluate the success of a good strategy. And we talked about that none of these measurements is really perfect, but one stands out for me as particularly useful because it's a well-rounded measure of quite a few things and can evaluate if management really applies their strategy very well. And that is EVA, or economic value added, also called economic profit. So in this session, I would like to take you through a practical example of how to calculate economic value added. It is not very straightforward. It takes some steps and some effort to get to that number. But once we are there, it is really very valuable to compare across companies and especially across competitors in an industry. So before we start, I would like to recap quickly what EVA is and how to calculate it in terms of the formulas. So the formula for EVA is we take net operating profit after tax, or NOPAT, and we subtract from that the invested capital times the cost of that capital. So what it gives us basically is an accounting number, which is the profit, as well as the opportunity cost of the invested capital that is needed to obtain that profit. And that's exactly the beauty of that measurement. It basically measures 3 different things in one number. It measures the profitability of the business, the capital needed to achieve that profit, and the cost at which this capital can be obtained. So let me dive into a specific example. And the example I chose is a Thai company. So we are going to evaluate Thai Foods Group, or TFG. It's a company that produces chicken and some other proteins, and it also distributes those proteins in their own stores across Thailand. So let me dive in, and I have set this up here in one Excel file, which you can see here. As a reminder, I copied the key formulas to calculate EVA and also the sub-elements like the WACC and the invested capital. And on the right side, I have a search window, like a browser window, where we can look up those numbers. So in this orange red box, we have the final outcome. So I skip over this first, and I would like to start with NOPAT. So a good website to start and to obtain those numbers is the finance section of yahoo.com. So if we type here in the browser finance.yahoo.com, here it is already. And it allows us to search for companies. We can look here for the full name, Thai Foods Group, or if we know the stock market abbreviation, then we can use that as well. So in this case, it is TFG for Thai Food Group, and then BK for the stock market here in Thailand for Bangkok. And here we have already Thai Foods Group. We can see that the share price, the latest share price was at 3.16. That is at close of January 31, 2025. And the beauty of this is it gives us a number of measurements and financials that we need to get to our EVA calculation. So let me start first. The first number that we need, and I set this up here already, is EBIT, or the operating profit. And we can here go on the financials, as you have seen, the financial tab, and we can get to operating profit or operating income. And this here is the number that we need. So I type in this number here. So this is 2,279,000,000 and 211,000. All these numbers are in thousands. And then we need the tax rate. So we can Google that as well. Corporate income tax Thailand. And it tells us that the corporate income tax in Thailand is 20%. So we can enter that here, 20%. And then we can calculate the tax that this company would have to pay on their profits, and that would be 456 million roughly. And we can calculate what is left of the net operating profit after tax. So we take the operating profit and we deduct the tax here, and we get to roughly 1.8 billion baht, Thai baht, it's the Thai currency, of operating profit. So far so good. And we have the first step. I kept the formulas here so you can keep track. Let us check that off quickly. So we have here the net operating profit already calculated. So the first step is done. Good. So next we need to calculate here the invested capital. So for the invested capital, we need to calculate the market value of equity and then theoretically the market value of debt, but that is rather complicated to calculate. So to simplify, we just use the book value of debt. And all of this we can obtain quite easily from Yahoo as well. So I go back to the Yahoo page on the right side here. And we have the share price. If we scroll up, 3.16 is the latest share price. So 3 baht and 16 satang is the latest share price. And now we need the number of shares. And the number of shares are listed down here. If we scroll down in the P&L, we see here diluted average shares. So we can take the full number of shares and we can put in this number here. So we have 5,810,995.75. So that's 5 billion shares, and therefore we can calculate the market value of the equity at this moment, which is the share price, multiplied with the number of outstanding shares, and we get to a number of 18 billion Thai baht roughly. Now the book value of debt we can also obtain from Yahoo Finance, and for this one we have to go to the statistic tab, and it will give us, if we scroll down, it will tell us here the total debt, and the total debt as of the latest most recent quarter, MRQ, the most recent quarter is 23.76 billion. So everything is in thousands, so we put here 23.76 and get to this number, billion. And now we can calculate the total invested capital, which is simply the sum of the market value of equity and the debt. So we add those two numbers up, plus this, and we get to a total invested capital in Thai Foods Group of about 42 billion Thai baht. So now we have calculated and completed the invested capital. So most of the numbers we already have. Last, we come to the value added, the weighted average cost of capital, the WACC. So that is a little bit more complicated to calculate, and we will go through this now. So the first step is easy. The WACC, sorry, I go up again. The WACC formula, weighted average cost of capital, is here. So we have to calculate the cost of equity, then the weight factor of equity as percent of the total capital, and then the after-tax cost of debt multiplied with the debt as the weight of the total capital. So what we can already do are those two weights here, this one and this one. So if you let me scroll down, the weight of equity is simply the market value of equity divided by the total invested capital. And we see here this is 43.59%. And then we already know the weight of debt as well, because that's just the book value divided by the total invested capital, and these two numbers need to add up to 100%, which they do. So the weights we already have, and let me scroll up again. We can cross that out as well. So we got this weight factor here, and we also got this weight factor here. So last thing we need now is the cost of equity, and then the after-tax cost of debt. Okay, so for the cost of equity, as we discussed in our lecture, we always start off with a risk-free rate. And the risk-free rate is basically the 10-year government bond in a AAA rated country. And because we are here in Southeast Asia and we are evaluating a Thai company, it would make most sense to take some AAA rated countries that are nearby. One AAA rated country would be Singapore, but I usually like to work with Australia when we work in this region. So what we can do here is we can look for the 10-year government bond in Australia, and usually I get this from CNBC, which is a reliable source. And we see here, when we click on this, that as of now, the 10-year government bond of Australia comes at a yield of 4.456%. So let us put this in here, 4.456%, rounded to 4.46%. Good. Then we need two more things to calculate the cost of equity. One is the equity risk premium, because we are in Thailand here, so we need to add the equity risk premium for Thailand, and we need to also get the beta for the industry. In this case, it's the food processing industry. And both we can actually get from NYU, from New York University. So let me Google that quickly here. So we do NYU, equity risk premium. You see here from Stern School of Business, the website that gives us the risk premiums. And here we see a number of countries, and the second column here is the equity risk premium. So we can scroll all the way down to Thailand, and we can see here the equity risk premium for Thailand as of the latest, which is the beginning of January. Let me just verify this, is 6.46%. Let me put this in first here. 6.46%. And just to check when this data was done. So it's very recent, January 9, 2025. So just roughly 3 or so weeks ago. And then we need beta. And again, for the beta, we can use NYU. So I use this again here. I type beta and NYU. And then Google gives us here NYU Stern the betas. And as we have established, we are working on Thai Foods Group. Thai Foods Group is a company in the food or in the processed food sector. So here we have all the industries, and in the second column, we see the beta for that industry. So if we scroll down, you see here food processing. That's the industry that our company is in. And the beta here in the second column is 0.47. So what this tells us is that relative to the market volatility, the food sector is relatively less volatile, about half as volatile as the total market. So about 0.5 as the beta here. And with that, we can calculate our cost of equity. So the cost of equity is basically the risk-free rate plus the equity risk premium multiplied with the beta here. So that gives us a cost of equity for Thai Foods Group at 7.49%. Good. Now we have the cost of equity, and again we can cut something out here. Cost of equity is already done. Now back to the cost of debt. For cost of debt, again we start in a very similar way. We start with the risk-free rate of Australia. We can simply copy that from up here. And now we have to add the country risk premium of Thailand. Let me go back to the country risk premium. We had that already here. And we see here in the third column now the country risk premium. We can scroll down to Thailand again, and we see the country risk premium is 2.13. So we can type this in here, 2.13%. And as a last step to get to the cost of debt, we need to add the company risk premium. Now, for the company risk premium, we need to take a little detour. If I scroll up again to our formulas, for the country risk premium, for the company risk premium, we need to understand what is the rating of the company, so the credit rating of the company, and what does that mean in terms of the spread. Again, NYU is the most resourceful database. We can search here for NYU, and then we call that a synthetic rating. And here again on NYU Stern, we basically have a table that helps us translate the rating of a company into a spread, so into basically the risk margin that we have to add to our cost of debt for the risk that this company might default. Now, for Thai Food Group, I don't know the rating, but there is a little trick to calculate what Professor Damodaran of NYU Stern calls a synthetic rating. So we make our own rating basically, and that is using the interest coverage ratio. So you can see here in the table, once we have calculated the interest coverage ratio, then we can look up what the rating is, and we will know what the spread is that we have to add for this specific company. And for the interest coverage ratio, we need the operating profit, which we have already looked up, and we need the interest expenses. So the operating profit, let me just copy that from here. That's the EBIT here. So I copy that and I put that down here in my table. And I need to find now the interest expenses. So I go back to Thai Foods Group, and we need to go to the financial statements. And here in the profit and loss statement, we somewhere will find the interest expenses. Here it is. So in the most recent quarter, in the last 12 months, up to the most recent quarter, Thai Food Group had interest expenses of 957.136 million. So let me type this here, 957.136. Didn't type 957.136. And our interest coverage ratio, therefore, is the operating profit divided by the interest expenses. So it is this divided by this number, and we see, we can simplify this a little bit more. We're taking out some zeros here, but we come to 2.38. 2.38. So basically what this tells us is the operating profit generated by Thai Foods Group is enough to cover the interest expenses by 2.38 times. And then if we look up here, 2.38 is somewhere between 2 and 2.5. That gives us an implied rating of a B. So we can put that here already. The rating would be B in this case. And we have to decide whether we have small or large market cap. So this is low market cap here, and Damodaran defines low market cap as smaller than $2 billion or roughly 60 billion baht. If we go up quickly and look at the market value of equity, It's 18 billion baht, so we are talking about a low market cap firm. So we need to stick to the first table here, low market cap firm. And with a B rating, we need to add 6.5% risk spread for the company here. Yeah, so this is a low market cap. Low because this is less than US dollar 2 billion. And the implied risk premium was 6.50%. So I can put that up here. And therefore, the total cost of debt before tax would be the sum of those three. So we take the risk-free rate from Australia, we add the risk premium from Thailand, and we add the company risk premium for Thai Foods Group, and we get to a cost of debt before tax of 13.09%. However, we have to deduct tax, so we can deduct 20%, or a factor of 0.8 here. 20%, a factor of 0.8. So we calculate 1 minus the tax times our cost of debt, and that gives us a cost of debt after tax of 10.47% for Thai Foods Group. So now we really have everything that we need to complete our formula up here. So we also have the after-tax cost of debt. And now last we have to calculate the WACC, and we do that directly here in this field by using the numbers that we have calculated so far. So again, notepad we take from down here. Calculated that already. The WACC, okay, now we have to put in the formula. Again, we follow the formula that is up here. So WACC is the cost of equity, which we will find down here, times the weight of equity, which we have here, plus the cost of debt, which we will have here, times the weight of debt. And that gives us a WACC, a weighted average cost of capital for Thai Foods Group of 9.17%. The invested capital, we can again borrow from down here. The total invested capital was roughly 42 billion. And now we can calculate WACC times the invested capital. And that gives us a total cost, an absolute amount of that capital of 3.8 billion. And we can see already that the EVA will be negative. Again, EVA is the NOPAT minus WACC times invested capital. So we have to take the NOPAT here and deduct from that this number. And we can see that Thai Foods Group has a negative EVA of roughly 2 billion. So meaning in the last 12 months, the economic value add of Thai Foods Group was negative at 2 billion. As a little interpretation of that, Thai Foods Group has over the past years invested heavily in their own stores and their own distribution across Thailand, which is quite capital intensive. So the employed capital was quite high. And as you see with the debt level and the interest coverage ratio, the implied rating at B is also quite high, and therefore we have to add quite a bit of spread for the risk of that company. And therefore the cost of capital, the weighted average cost of capital is 9%, so slightly higher than the average 8% that we typically see globally as an average. So with that high investment and high cost of capital, at least for the short term, it looks like that the economic value add created by Thai Foods Group is negative. However, if their strategy plays out and as like the depreciation wears off and the stores gain more traction and more popularity among the population, if the strategy works out, then there is a good chance that this number turns positive in a few years from now. But right now, at least, it is still negative. So this is how to calculate the economic value add. You see it takes quite a bit of time and effort to get to the number, but it is very insightful into the management and the economic profitability of a company. I have one last remark on this. There is a second way of how we can assess the economic value add, and that is by looking at economic value add as a percent of invested capital. So by simply reshaping the formula a bit, basically dividing by invested capital across the entire equation here, we get EVA as percent of invested capital. And that is basically the NOPAT, the net operating profit after tax, divided by invested capital minus the WACC. And NOPAT divided by invested capital is actually nothing much else than a return on invested capital. So we can express EVA as percent of invested capital by calculating ROIC minus WACC. So if we know the return on invested capital and we know the WACC, then we can also see whether the economic value add is positive or negative. And let me just show this quickly here in the sheet. So I set this up here already as a second sheet and already calculated over the numbers. So the invested capital, again, we can borrow from the previous tab. The invested capital was 42 billion. The return on this capital then is basically these two numbers divided by each other. So we can take the NOPAT divided by the invested capital, and that gives us 4.33%. And we can already see from the number here that 9.17, which is the cost of capital, is higher than the return on the capital that is generated by Thai Foods Group. And therefore we have in percent a negative of roughly 5%. Let me just change this number to be a percent. Yeah, so negative 4.84% EVA as percent of invested capital. Okay, so we are at the end of this session. I hope you found this useful, this approach of how to calculate the EVA. And as I said, like for me, it is a very useful measure because it is a well-rounded measure of the management's efficiency and the way the management applies the capital, as well as the way management can generate profit for the company. So therefore, it should be quite useful in assessing companies and also comparing companies across industries. Thank you so much for watching.